Since the 1980s, the global bond market has been in a bull market. That means on average for the last 40 years, bond prices have been moving higher while interest rates have been going down. But that has all reversed as over the last couple of months, things have gotten out of hand, to say the least, economically speaking, around the world, and bonds are now in their first bear market in decades. Ready? Let's dive in. You can see here that the Bloomberg Bond Index has dropped 20% from its January 2021 peak, as this chart shows absolutely massive drawdowns. This is particularly painful for most Americans in their 401ks and their pensions, as the majority of asset managers have people in the 60-40 portfolio. Because historically, if you have some of your money in bonds, some of your money in stocks, then when stocks don't do well, it's because money is flowing over into bonds. When bonds don't do well, you're in a better growth environment, money's flowing back over to stocks, and so they balance out your portfolio. But over the last 6 months, this has been absolutely demolished as bond prices as well as stock prices have fallen. Now, that's one of the reasons why I designed my portfolio allocation course to teach people how to bulletproof their investments against things like this. 10% off through Labor Day, link is in the description below. But this also highlights the need for a crazy change from the current environment where central bankers for decades have thought that they could fine-tune and manage the economy, and it is all falling apart. Take a look at this chart. This is the yield on the 10-year Treasury, and we can see that since the 80s, it has done nothing but trend down. Now, before 6 months ago, I stated over and over and over again that the Federal Reserve would not be able to continuously raise rates because they would hit the point that they've always hit before, and then that causes them to pivot. Looking at this chart again, you can see there's a very clear trend line on the top. Every time interest rates got to a certain point, they stopped raising interest rates and dropped them again. But we are well above that top trend line now, and it looks like we may be breaking out into a new era of interest rates going up. Now, why is it that the Federal Reserve did not pivot this time like they would have already in the past? Well, it's because this time is different. Well, yes, because of inflation. The CPI is showing inflation rates that it hasn't shown in decades. What does that remind you of? The 70s. Let's go back to this chart. Why were rates so high back here in the 80s? It's because we had a decade of inflation from coming off of the gold standard, no restriction on how much money the government could print into existence, prices rose, and the Federal Reserve was raising rates to combat that as well. So we had this decade of interest rates going up because of inflation. And then through a number of factors, including changing the way inflation was measured, inflation started to come back down in the 80s, which meant that the interest rates for debt and bonds were allowed to come down as well, starting the last 40 years of the bull market in bonds. Now, just in case you are not clear on the relationship between interest rates and bond prices, I'm going to explain that very simply here. If you've heard me explain this a couple times before, just skip forward. Chapter markers are listed below. A bond's price and a bond's interest rates are inversely correlated. This is because if I borrow $100 from you, I now owe you $100. Let's say the interest rate is 1%. How much do I owe you? $101. So I borrow 100, I owe you 101. That exists as a financial instrument, as a contract between us, and you can try and sell that to somebody if you want to. So you go to somebody else, and let's just say for whatever reason there's high demand to get to have debt from me. Somebody decides to buy that debt from you, but they pay you $101 for it. How much do I now owe the other person that just bought that debt from you? I still owe them $101. They paid $101. They're getting $101 back. What's the interest rate on that? 0. If they were to pay $102 and I was to then still owe back at maturity $101, then the interest rate would be negative. If you instead sold that debt for $99, I'm still paying back $101. That person only paid $99 though, so it's about 2% interest rate for them. And so over the last 40 years, the inflation rate has been moving lower, which means that investors have been willing to accept lower interest rates on the debt, on the money that they're lending out. Why is that? Well, because you have a higher expectation that when that debt gets paid back, it will be worth at least the amount of purchasing power that you originally lent. So back to you and me. I borrow $100 from you and I give you $101 back in a year. If you think that prices are going to double in between now and then, you're not going to accept a 1% interest rate because you're going to lend me $100, but then when you get $101 back, anything that you could have bought for $100 is going to cost you $200. You're not going to make that deal unless you can make sure that the interest rate will compensate you for that. But in an extremely low inflation environment or a potentially deflationary environment, like, technology has been in a very deflationary environment for decades. Technology gets cheaper and cheaper every year. So you might be willing to lend at a negative 1% interest rate. You give me $100. I give you $99 back. You might be okay with that if in a year from now, when that comes around, everything else is now only $90 because you have a real return on your money now. You lent out $100, you get $99 back, but everything costs you $90. So even though the nominal rate was negative, your real return was positive. So going back to this chart, when we see interest rates coming down, inflation was coming down as well. So investors and lenders were willing to accept lower interest rates. But what is different now? Inflation. Inflation is getting up to levels that we were at the peak of inflation in the 70s. So it's very possible that we are embarking on a new era here where interest rates for a very long time are going to continue to head higher, and if inflation sticks around, that's almost guaranteed. So the question is, well, what is the likelihood that high inflation sticks around? Well, we have to look at the drivers of inflation. Obviously, the expansion of the money supply is a big one, and that was the thing that really got it kicked off. But there are other factors in play as well, such as deglobalization. As deglobalization happens, that's an inflationary force because globalization was deflationary. It allowed, especially Americans, to get a lot of things for much cheaper. As that unwinds and as nations around the world become more nationalistic, more isolated, as there's more geopolitical risk, more war, things like energy will get more expensive. Things like imports could get more expensive. Things like food could get more expensive, regardless of what the money supply does. And so if interest rates continue to go up, the Fed continues to sell assets off of its balance sheet and continues to suck money out of circulation, you could still have inflation in many items, considering everything else that's going on, which means that we very well could be entering into a period of very extended inflation, especially in certain things, which means that interest rates could continue to go up for a very long time here, which means bond prices continue to go down. Not a good look for investors moving forward into the next 5 to 10 years, considering bonds make up the largest asset class second to real estate, and stocks are a way smaller market than bonds. And as global bonds continue to deteriorate, that will put more and more pressure on borrowers, on people who have to roll over their debt. Costs of servicing that debt go up, and any investors holding on to that debt. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.